Hey, welcome to this week's episode of State of Real Estate. My name is John Carismo, and the show is brought to you by the Tampa School of Real Estate. We're here every Friday at 12 noon Eastern Time to help you understand how to grow your real estate business. And now, whether you're maybe looking at real estate yourself as an investment, or maybe you're a real estate professional or aspiring to be a real estate professional that wants to assist others in investing in real estate, this is where you're going to want to know with one of the big things that could be a huge expense of real estate or maybe a huge benefit of real estate, and that's the capital gain taxes. Now, I am going to make the disclaimer first and foremost here. I am not an accountant. I am not a CPA. I'm not an accountant. I'm just a real estate professional. I'm a real estate broker, and this is my perspective on the knowledge that I have about this and how you can relate this to your clients. But in the real world, we're not accountants. We don't pretend to be accountants, but we want to know what those doors are. We want to know that those doors exist, and it's going to be the accountant behind the door that helps make all this possible, that does the actual nitty-gritty details of this here, but we want to at least know these doors are available and how we could leverage these doors, leverage these opportunities that exist with something like the capital gains exclusion. So we're going to talk about the capital gains exclusion, what type of properties that applies to, how much it actually is, how do you qualify for that capital gains exclusion. So that's what we're talking about today, capital gains, potentially creating tax-free wealth. It's possible, it's doable. Let's talk about it on this week's episode of State of Real Estate. State of Real Estate. Every Friday at 12 noon Eastern Time. Grow your real estate business. You're watching State of Real Estate. Hey, welcome back to this week's episode of State of Real Estate. My name is John Carismo, and this show is brought to you by the Tampa School of Real Estate. We're here every Friday, 12 noon Eastern Time, to help you understand the technical side of the real estate industry. So, what we're talking about today is capital gain. So capital gains taxes. Now, capital gains taxes, for a brief overview, if you're not sure what capital gains taxes are, capital gain taxes are the taxes you pay when you sell something and essentially make a profit selling it. So when you sell something and you profit, we have what's known as a capital gains tax. Now, there are times where this can be excluded. That's for your principal residence. We'll talk about some of the qualifications that would potentially qualify you for capital gains tax exclusion. And then we'll also deal a little bit with the investment side of things as well, for investment where this is not your primary residence, of how capital gains taxes factor in. Now, they're already the lowest tax rate. So if you are stuck having to pay a capital gains tax, it's already one of the lowest tax rates that you'll have to pay. This is not the same as income tax. So this is, again, the idea that you buy something for. We'll keep this super simple here. And again, the disclaimer, I am not an accountant. I'm not pretending to be an accountant. Contact your accountant in the real world before you try any of this stuff, because they're going to be your shepherd that guides you through the 80,000 pages of IRS tax code to make sure that you're really able to qualify for all of these particulars, that you're crossing every T, dotting every I, and you don't end up getting audited by the IRS. So again, involve an accountant in the real world before you try any of this stuff. But let's say that, and this is a little bit of an oversimplification, but you've got a cost on a property of, we'll say, $100,000. Then you've got a property for $100,000, then you go to sell it, and the price that you sell it for is $200,000. And this $100,000 cost, this will include how much we pay to acquire the property, as well as any capital improvements we make to the property, as well as expenses of the sale, commissions, things like that. So that's going to be pegged at the $100,000 there. And what that means is this gap we have between this $100,000 in cost and $200,000 in price, we would typically call this, if we're just talking person to person, we would probably just call this a profit, that we profited $100,000. But that profit, as far as the IRS calls it, they call that a gain. And then that's going to be what's subject to the capital gain tax. Now, again, if you did have to pay the capital gain tax on this $100,000 profit or gain here, it's already going to be some of the lowest taxes that exist. But look, this is for you as a homeowner. This is for you advising homeowners. what's known as the capital gains exclusion from your primary residence. So the capital gains exclusion from your primary residence. And there's two thresholds here for this exclusion. Now, again, this is for your primary residence. This does not apply if this is an investment property or something like that. This has to be your principal residence. And what ultimately qualifies this as your principal residence is that you've resided there for 2 years. 2 years you've lived there, you've claimed that as your primary residence for the past 2 years. And if you file your taxes single, you get a $250,000 exemption from capital gains. And if you file your taxes jointly, you get a $500,000 exemption from capital gains. So what does that mean? That means this $100,000, if this is your principal residence and you've lived here at least 2 years, no capital gains taxes. That $100,000 there that you're gaining would normally be subject to capital gains taxes, but if this is your principal residence, whether this is through appreciation of the property, whether again you're making some capital improvements, whatever the case it may be, that $100,000 in profit you have on your property or as a capital gain, whether you file your taxes single or jointly, you don't have any capital gains tax bill. So this is huge because that's $100,000 there tax-free. This isn't like you get $100,000, but then with taxes that comes out to like $50,000, $60,000. No, this is $100,000 in profit equals $100,000 in profit, and that's it. And if this is your principal residence, we're going to talk about a 1031 or like-kind exchange as well, because that's maybe something you could use for an investment property that would not qualify for this because, again, this is an exclusion specifically for your principal residence. But there's no need to reinvest this money. It's probably the smart thing to do to go reinvest that $100,000 that you made, but you want to go buy a boat with that, you want to go blow it at wherever, that's fine. You've got this $100,000 tax-free because of this capital gain exclusion. And so what this allows for is for somebody that goes and buys a home, if they live there for at least 2 years, even if they just file their taxes single, that they're exempt, they're excluded from $250,000 in gain, in profit. And if they file their taxes jointly, they could get up to $500,000, $500,000 in gain exempt. So going back to our scenario we had here, let's not say that we sold it for $200,000. Let's say we took this property where we have $100,000 in cost. And let's actually make the numbers a little bit bigger here to where, maybe that's something that'll more likely happen. Let's say that we've got $1 million in cost. And then when we sell it, the price that we receive, and that's $1 million is factoring in all of our costs that are able to be excluded from this capital gain, and that we have a $1.5 million price. So now it's not a $100,000 profit we've got here. It's a $500,000 profit. Now, you or your clients might not be in the position to purchase $1 million property that maybe could experience this $500,000 gain. That's still a huge gain there. That doesn't seem like it's a lot of money, but this property value increased 50% going between these two things here, and that you just have to be there again for at least 2 years to be able to qualify for this capital gain exclusion. Then they would have to file their taxes jointly if they want to be able to exclude that entire $500,000. But for your average client, or maybe somebody who can't get into that $1 million property yet, who might not be able to fully maximize that $500,000 capital gain, even going back to that $100,000 gain that we had previously. If they want to invest in a new property, they now have that $100,000 they pulled out of that property that they could put in a new property completely tax-free, or whatever it is that they want to do with that capital gain. Because again, if this is your principal residence, it's completely excluded. And this is something that this is the real benefit. So I know there's debate out there, depending on who you might talk to. Some people might say, oh, real estate's a great investment. Other people might say, oh, no, real estate's not a good investment. Some people might say real estate is a great investment if. all real estate can be a great investment. It's depending on how it is that you're looking at it and what it is that you're trying to do. Now, every homeowner, this is something extremely important to remember, every homeowner is an investor. Every homeowner is an investor, but they're not investing for cash flow. They're not investing to rent out their property. They're buying a property for investment in appreciation. And the appreciation, and we're used to being taxed every which way. We've got income taxes for when we make money. We've got property taxes for when we own the property. We've got sales tax for when we buy things. We die, we've got the death tax, the estate tax. So we're used to being taxed for everything. And we probably would figure, oh, well, I make $500,000, I make $100,000, whatever it may be. I'm going to have to pay taxes on that. Even more taxes. I don't want to even do this because I'm sick of paying taxes. Well, again, this is something that I talk to realtors that don't even know about this capital gain exclusion. This is huge. This is a huge benefit for somebody buying a property as their home because this allows that appreciation they're receiving to be tax-free wealth. Again, I'm not an accountant. Consult an accountant in the real world before you try to actually attempt to do this. And when you give that advice to your clients, you want to let them know that this door exists, that this is an option that exists. It's like, yeah, you're going to talk to your accountant to find out how you could take advantage of the capital gain exclusion so when you do make money on this property, that you could exclude hopefully all of the gain that you're getting off of this property. And they might say, well, when can I not exclude the gain? Well, if you're going to live there less than 2 years, or if your gain is going to exceed $500,000 when you file your taxes jointly. Because if you got a $600,000 gain, it caps out at $500,000 for the exemption, so you would have $100,000 subject to capital gain taxes. But that's a huge... Where else can you go and make $500,000 and not pay any taxes? What can you do where you're going to make $500,000 and not pay any taxes? Now, this isn't quite a investment because, again, this is based on your primary residence, but this is when you're dealing with homeowners. This is the thing that most people miss, and this is the big driving factor that has drove the real estate market for centuries. We'll say centuries. I don't know how far back this typically goes, but it's appreciation. That you go get a cave in a desirable area, or maybe the cave isn't too desirable, but now the village kind of congregates around this cave, and all of a sudden your cave is worth so much more money, or more whatever is valuable then, more gold, I guess, supposedly then. But that appreciation there, with taxes, would normally be taxed. We'd have to pay on this, except for this is our primary residence. We'd lived there for at least 2 years, tax-free. It's crazy. Wrap your head around this number. Not that you sell your property for $500,000, but you profit $500,000. You profit $500,000. Again, where can you make $500,000 and not have to pay any taxes on that $500,000? You go win $500,000 at a casino somewhere, you hit the lottery, you're going to pay more taxes than you ever know even existed in taxes. But this capital gain, as long as it's your principal residence, you live there for at least 2 years, and you spoke to your accountant to make sure that there's no stones left unturned for your situation, you've got that $500,000 tax-free. Now, this is if you're using this as your principal residence. Now, there are some capital gain, not necessarily exclusion, but capital gain protections that exist for an investment property, for a second home, for a vacation home, for an investment property that you're renting out. And there are things that you could do that's not the same capital gain exclusion, because, again, this is for your primary residence. And if you're not already taking advantage of this, you're leaving potentially $500,000 on the table. And even if you can't get that gain of the $500,000 yet, you need to start buying the place where you live so you can start taking advantage of the appreciation. Now, real estate historically always appreciates in value. There are up and downs to that appreciation. If you don't want to buy high and sell low, but you waited out long enough, and even if you did buy high, it eventually will recover past that. And part of that's driven by inflation as well, that's just causing prices to constantly increase. So, again, there's a lot of ways to go wrong with all this stuff. You could sell too soon before this recovers, or whatever the case may be, but it's not a matter of if the property will recover in price, it's a matter of when the property will recover in price. And the more educated, the more trained it is that you are about what you're doing. And for your clients, the better it is that you're able to inform them. Because in any market, you could always get a good deal. It's just a matter of finding that good deal. And they're harder to find in a good or in a seller's market. So This is always possible. You always have these capital gains exclusions until they change the tax code. You have these capital gains exclusions. You've got to take advantage of it. You've got to get your clients to take advantage of it. If somebody's on the fence about buying a property or maybe selling their property to be able to buy a new property, that gain they're going to get is tax-free as long as they live there for at least 2 years, as long as they've talked to their accountant and cleared everything with them to make sure the accountant knows what they're doing so they know what they've got to do when they actually file these taxes, because that's the other side of this, and that's why, again, you want to involve an accountant. And if you're one of those people out there that use TurboTax or these little online types of taxes, especially if you're self-employed as a real estate professional or you're running any sort of business, quit wasting your time doing your own taxes because you're also probably doing them wrong and you're costing yourself tons of money. Get an accountant, get a trusted advisor that's going to know what they're doing, that's able to see these doors that you didn't know exist. Again, we're not the accountant. We're not the person that's ultimately doing their taxes for them, but we want to let them know that these doors exist, that these paths exist, that this is a possibility with real estate. Now, we're going to take a quick commercial break, but when we come back, we're going to talk about the investment side because you don't get this exclusion from investment property unless this investment is your home that you're living in for at least 2 years. But for an investment property that you're maybe renting or whatever the case may be, we're going to talk about how capital gains are a little bit different, how you might be subject to capital gains, or how you can maybe potentially defer these capital gains or maybe offset the capital gains. So different rules apply when this is an investment property. But first, we're going to take a quick commercial break. Stick with us. I'm John Kursmo. You're watching State of Real Estate. What's required to become a Florida real estate broker? Well, a few things. Number one, you have to have at least 2 years experience as a sales associate or a broker. Now, this experience could actually even be earned outside of Florida. It just has to be 2 years within the last 5 years. So 2 years of experience to become a broker. You also need to take a pre-licensing course. The broker pre-licensing course is 72 hours. It's got a 100 question and of course exam. Once you pass that and file all your paperwork with the state to upgrade to a broker license, then you just need to pass your state exam. That's another 100 question exam. You need to get a 75% on that. You complete those items and you'll have a Florida real estate broker license where you can open your own office or just remain with your current broker as a broker associate. To find out more about upgrading your real estate license to broker, check out upgradeToBroker.com. That's upgradeToBroker.com. Are you watching State of Real Estate? And welcome back to this week's episode of State of Real Estate, where today we're talking about capital gains for tax-free wealth. Now, we already talked about this to really make it truly tax-free when this is your principal residence. There is a section of the IRS code that's set up to give you these exemptions. If you file your taxes single, $250,000 of exemption. If you file your taxes jointly, $500,000 of exemption when you sell your principal residence. As long as you've lived there at least 2 years, and again, of course, in the real world, you've talked to your accountant to make sure that they're on the same page of you when you're doing this. So that's for when we're dealing with your principal residence. But what now when we're dealing with an investment property? How are the rules different when we're dealing with an investment property? And the first thing is, there is no exclusion for investment properties. If this is an investment, the government wants to get their cut. But the thing is, the government doesn't necessarily want their cut today. They'll let you maybe pay them their cut tomorrow for a potentially bigger cut or whatever the case may be. We'll get to that in just a second, but first I want to talk about the concept. We just talked about a capital gain where you're making money, but then you might also have a capital loss where you're losing money. And let's say that you gain $100,000 on one property, but then you have a loss of $100,000 on another property. Did you really actually profit anything? The answer is no. So if you've got one property that gained $100,000, and this is all investment. So this is, again, all investment. Your principal residence, you're actually not allowed to declare a capital loss. That has to be an investment property. So we're dealing strictly within the investment realm here with investment properties. But if you have one investment property, we'll call it property A, where you gain $100,000, and then on property B, you have a capital loss of $100,000. What happens? These two wipe each other out. The gain is offset by the loss. And so effectively, you've got a profit of zero. Which, what's the taxes on zero? That's the one other way to not pay taxes, although you probably still will pay taxes in some way, form, or another. But the one way, a surefire way to not pay taxes is not have any income, not have any gains. Then you don't have to pay any taxes. So that's the other way about it as well. But you probably want to make some money. So that's where this whole idea of minimizing your tax bill actually comes in, of avoiding taxes. Not evading taxes, but avoiding taxes. Evading is illegal. Avoiding is 100% legal as long as your accountant is doing everything correctly. So that's the whole idea of a capital loss. But you probably don't want to lose money anyways. You're probably saying, well, I don't want to lose money. But that is the upside to losing money. There is an upside to losing money, is it'll offset your gains. And you also talk to your accountant about being able to carry these over to different years as well. Again, make sure you've got an accountant that knows what they're doing. Not just TurboTax, not just H&R Block or whatever these online things are. If you're just an employee and you don't make much money and you don't have any investments or anything like that, that's what TurboTax is for. But if that's not the case for you, do not use these online systems where you do it yourself. Do not use the software where you do it yourself. Hire a professional that knows what they're doing, that knows how to help you take advantage of the tax code to your benefit. Again, this is perfectly legal. You just have to get the right person that's going to show you the right doors and be able to open and take you through those doors. But let's talk about the tax-deferred exchange, also known as a like-kind exchange, also known as a 1031 exchange. So this whole idea of the 1031 is, yes, if this is an investment property and you're actually profiting, there's no losses offsetting your profit, the government wants their cut. The government wants their cut of your gain. But with a 1031, they say, well, you know what? You could pay us tomorrow. You could pay us later. They want their money, but they don't necessarily want it now. And why do they not want it now? The whole IRS tax code is designed to incentivize what the government wants done. That's the way the government incentivizes what it wants done. And what the government wants done is they want the private sector to create real estate investments. And that's why they have these advantages in here for real estate investments. Because the government's not providing the housing. I mean, they do to a certain extent, but even that's pretty privatized to a large extent of it for the actual actions taking place. But this 1031 exchange, so let's say you've got a $1 million gain that you have. Maybe that's an office building, maybe that's a multifamily building, maybe it's just a single family home that's an investment property, whatever the case may be, but you have some piece of real estate that has a $1 million gain. Now, if you want to take that money and run with it, you've got to pay capital gains taxes, which again are already the lowest tax rates compared to pretty much any other tax rate. But let's say you don't want to pay that capital gain tax. And the reason why you might not want to pay that capital gain tax is you want to turn around and reinvest that money so you could turn it into an even bigger sum of money. And that's where the IRS tax code of the 1031 exchange comes into play. That you take this $1 million gain and you reinvest it. And now, again, there's a lot more to this than just the simplicity that I'm showing you this opportunity of this here. In order for this to qualify as a 1031 exchange, not only do you have to reinvest it, but it needs to be within a certain period of time. And during this period where it's not reinvested yet, it needs to be held with what's known as a qualified intermediary. Who is a qualified intermediary? This is a private organization that helps you take advantage of the 1031 exchange. Talk to your accountant and they could probably recommend somebody, especially if this is an accountant that knows what they're doing with real estate, they could probably recommend somebody who is a qualified intermediary. Maybe your accountant is even a qualified intermediary that will help you be able to reinvest this money and take advantage of this 1031 exchange. So you reinvest this money into a new property, and now when you sell that new property, in theory, if you're able to gain money off of this property, you should hopefully be able to gain more on this next property. So let's say you've got now a $2 million gain. But the way this gain is calculated from this $2 million, because maybe you just gained another $1 million. That's what this property added on. But now you're taking it from this being your basis point down to here. So you have the $1 million gain here, you have the $1 million gain here, so now your total gains come up to be about $2 million is where you're sitting at right now. And again, you want to take the money and run, you've got to now, again, pay the capital gain taxes, which again, they're going to be the lowest tax rate, but maybe you want to keep your money in. Maybe you're not ready to pull your money out yet. So now maybe what do you want to do? Well, maybe now you want to take that and reinvest it yet another time with yet another 1031 exchange. And you could really keep this going. Again, talk to your accountant for details on this finer, but this is an advantage of reinvesting your money because the government knows that you're probably going to be able to make more money. If you're able to achieve a gain, then you're probably going to be able to achieve a gain again. And they're basically saying, you know what? We'll let you get another gain. And when you're ready to finally take that money out of your investments, now, at this point, we're going to charge you that capital gain tax. Again, this is a little bit of an oversimplification. It's really a lot of bit of an oversimplification of what really goes on with this here. But you want to know that this door exists. You want to know that this is an opportunity. If you're in the position where you've got a property that's an investment property where you're sitting on a gain and you don't want to pay the capital gain taxes on that gain, you've got two options. Either have a property with a capital loss to offset that, but you having a loss means that you lost money, which you probably don't want to do. But then the other option is to say, hey, I'm not going to pay the capital gain tax today. I'll pay it tomorrow. I just need to use a 1031 exchange through a qualified intermediary to reinvest this money into a new property, keep increasing my gains until I get to the point where I am able to take out my property, to take out my gain from the property, to pull my money out from investing in real estate. And the benefit of doing this not only is that you are able to put off your taxes until tomorrow, which, that might not be something that you're too keen on. You say, well, why don't I just pay it today instead of paying it tomorrow? It's better if I pay it off now when it's small rather than letting it balloon up into a larger and larger capital gain tax. What better position are you going to be in to pay taxes when you've got $1 million you're sitting on or $2 million? Or if you're keeping to reinvest this, if you're at $3 or $4 or $5 million. Yes, the tax bill is going to increase, but you're probably in a much better position to be able to pay taxes when you've got $4, $5, $10, $20 million in gains, rather than just having a $1 million gain. You lose one penny of that $1 million, and guess what? You're no longer a millionaire. You go from being a millionaire to going to $999,999.99, which is not really technically a millionaire. So you don't want to pay the taxes here because you want to be in a better financial position to be able to pay your taxes. And on top of that, during all this time of you owning investment real estate, you're able to take advantage of all the other incentives from the IRS. I don't like even calling them deductions. I don't like calling them rules. I like to call them incentives because that's what they are. That's what the government is doing. And you might talk to some people that might say, oh, don't you want to pay taxes? Don't you like schools? Don't you like whatever? Hey, guess what? All those local services you'd like to talk about, is at least in Florida, they're mainly paid by your property taxes. So you want better ones of those? Pay more property taxes. This money going to the IRS, to the federal government, a very small amount of that, if any of it, is actually what trickles back down to the local level. So, but that's a whole nother can of worms and a whole nother rabbit hole we could get down into. But during this time of you owning real estate, you can take advantage of the depreciation deduction, the deduction of operating expenses, or the incentives, as again I'd like to call them, the incentives for depreciation, the incentive for operating expenses. And then that helps you shave away the money it is that's going to be subject to taxes. And this is, again, have I mentioned that I'm not here broadcasting to the world how to do illegal things. This is 100% legal. Talk to your accountant. Get an accountant that knows the IRS tax code that has to deal with real estate. So get somebody who's well-versed in real estate. Not all accountants are created equal. There are accountants that have specializations in different areas. So make sure you're dealing with an accountant that does have a specialization in real estate, that knows all the benefits of the IRS code for real estate, because there's a lot of incentives that exist for real estate. And whether this is for your principal residence or if this is for your investment properties, there's tons of incentives that exist out there. They're all different and they get very complicated. Again, tax code, it's like 80,000 pages long. Don't try to do this on your own. Bring in a trusted advisor who knows what they're doing, an accountant that really knows, again, real estate, tax code, who could then also advise you on what it is that you could do and go through these hypotheticals with you. I mean, finding an accountant that's willing to just sit down and talk to you to go over what you should do to be able to minimize your tax burden, that's already, and again, this is doing it legally. This is doing it legally. This isn't some loophole that exists. This is the specific rules written by the IRS because they want to incentivize real estate investment. Because why? We need real estate. We need places to live. We need places to work. We need places to hang out, to shop, to do all these different things. And there's incentives that exist in the IRS tax code. You just got to go out there and take advantage of them. That's how Donald Trump is able to amass all the wealth he has, and everyone that's around him that's, similar to that. It's through real estate. And they're not breaking the law doing this, at least as long as they're doing stuff, according to the IRS rules. Everything that they're doing, they're able to do using the incentives that exist in real estate. So there's so many people out there that could take advantage of this. You are able to take advantage of this. You just have to get the right knowledge. You have to have the right training. You have to find the right deals, the right properties, because there are ways. Just because you should not invest in a property just because of the tax advantages. But the tax advantages are maybe what makes this now a worthwhile investment. This is now what makes this something where you would make money. Something where you can maybe shelter your other income. That whole idea of a tax shelter, that sounds like such a bad, maybe illegal thing, but a tax shelter is 100% legal if it's done correctly by using depreciation deduction, by using these incentives that exist from the IRS to invest in real estate. So look, if you want more about this, there are more things that we cover in our courses about investment real estate and things like that. But ultimately, when you do want to put this into practice in the real world, you need to talk to a good accountant that knows real estate law. If you want to find out more some of the fundamentals, more details about these doors that exist, the hypothetical types of situations, if you're a broker, we've got a broker investment course that deals specifically with this whole investment real estate concept. It deals specifically with investing in real estate, and that's part of the broker post-licensing education. So if you're a broker and you've got to do post-licensing, that real estate investment course can cover that. And if you're not a broker and you just want to learn more about real estate investment, go take the broker post-licensing. You can still do that even though you're not a broker. But look, that's about all the time we've got for today. If you've got further questions, if you want to get your real estate license, if you want to find out more about starting a real estate career, if you want sales training for your real estate career to be able to relay this information to your clients in a way that will win them over to your way of thinking, that'll help them understand this in a way that it can be an advantage to them. That's what our sales training is for. So if you want any of that stuff, give us a call. We've got advisors standing by to be able to help you out. The phone number is 813-333-2676. Again, that's 813-333-2676. It's about all the time I've got for you guys today, so thank you for tuning in. Thank you for watching. Make sure you hit the like or the subscribe button so that way whenever we go live, hit the little bell icon so you get notifications. So that way we go live, we come to give you this information. You're not going to miss any of this because this is really powerful information that you're going to want to have. It's all the time we've got for today. Thank you guys for tuning in, and I'll see you next week. Hey, so if you're thinking about starting a real estate career, it could feel a little overwhelming sometimes. Look, that's completely understandable. That's why we're here to help. If you haven't already, check out our Success Center, tampaschool.com/success. Or if you don't even know where to begin, give us a call. We'd love to help you out. We've got advisors standing by to answer any questions you have and assist you in any way it is that we can. Our phone number is 813-928-0106. Again, that's 813-928-0106. Give us a call. We're the Tampa School of Real Estate. You're watching State of Real Estate.